Scott Groves with another mortgage mystery, and this question actually came to us via Facebook from one of our favorite realtors. And the questions are, why are adjustable rate mortgages, or ARM mortgages, considered bad? And, sadly, in 2008, 2009, as the mortgage market was collapsing, it was very easy for regulators, consumers, and politicians to point to this ARM, or adjustable rate mortgage, as the program that got out of control, crashed the mortgage industry, which in turn crashed the banking industry, which in turn almost crashed the world economy. So if you remember back to a couple famous politicians talking about liar loans and adjustable rate mortgages that were going to put everybody out of their house, the mortgage, or the adjustable rate mortgage, kind of got vilified. And it's unfortunate that that's the case, because adjustable rate mortgages are not intrinsically bad. And let me give you quickly an education on adjustable rate mortgages. 95% of consumers across the country get what's called a 30-year fixed mortgage, meaning you take out $500,000 in debt, your payment is exactly the same for 30 years, and you make principal and interest payments throughout that 30 years. You pay off your home, and then the bank gives you the note or the deed to your house, meaning you've paid off all the debt. Well, the reality is most clients aren't going to stay in their house for 30 years. The reality is most homeowners in America stay in their house for about 7 years, and they keep their mortgage for an average of about 4.5 or 5 years, because things change. Interest rates go up and down, refinance opportunities present themselves, people need to take cash out of the house in order to do renovations, or they sell, they buy, they upgrade, they downgrade. So decades ago, this program called the adjustable rate mortgage was created. And an adjustable rate mortgage simply means for a certain fixed amount of time, 3 years, 5 years, 7 years, or 10 years, your mortgage is going to feel and look exactly like a 30-year fixed mortgage. So in my same example as the 30-year fixed mortgage, where your payment is exactly the same for 30 years, in what would be called a 7-1 adjustable rate mortgage, that simply means that for the first 7 years, your loan is going to be fixed, your payment is going to be exactly the same, nothing will change, and then after the 7 years, you will have an adjustment to your interest rate and an adjustment to your mortgage payment once a year until you pay off that loan. Now, you can still keep that loan for 30 years, and it's a great tool if you know you're only going to be in the house for 5 to 7 years. Now, there's two reasons why people don't really use adjustable rate mortgages right now, or they don't use them more frequently. Number one is coming out of 2008, 2009, and even before that, if you talk to your parents, and again, these adjustable rate mortgages were really vilified, people might have a bad taste in their mouth. Number two, a lot of lenders don't know how to explain what an adjustable rate mortgage is, so it doesn't even get presented as an option. And then number three, and this is the only reason our team is not doing a lot more adjustable rate mortgages, is because of the compression of rates and the compression of margins in the mortgage market. So for example, when I started doing this job 22 years ago, I was seeing 30-year fixed rates around 5.5 or 6%. And if you were willing to take an adjustable rate mortgage that was fixed for 5 or 7 years, and then the bank could adjust the mortgage and the interest rate slightly once a year, your rate would go from maybe like 5.5 to 4 or 4.5. So there was a huge spread and there was a huge savings for taking the risk of taking that adjustable rate mortgage. I tried to talk people into adjustable rate mortgages until I was blue in the face, because I knew a lot of these first-time home buyers who I was talking to, they weren't going to keep their mortgage for more than 5 or 7 years. Unfortunately, most of those people opted for 30-year fixed loans and then had to refinance at some point in the future anyway, because luckily rates have gone down. However, and this gets back to why our team is not doing a ton of adjustable rate mortgages right now, what's happened is that as interest rates have come down and we're floating somewhere around 3% on a 30-year fixed mortgage, if you're willing to take a 5-year or a 7-year fixed and then it becomes adjustable, the spread in the interest rate over the last 20 years has gone from something dramatic that saves you a ton of money to, maybe you get 2.625 or 2.75% instead of 3%. Now, this could change if we go into an inflationary environment where the Federal Reserve and the government starts to raise interest rates. If we get back to a point where interest rates are at 4%, 5%, or 6%, depending on how long this video is on the internet, it might make sense to look at adjustable rate mortgages again, because the spread between the rate on a 30-year and an adjustable might be enough to justify the risk. But like I said, I don't know that there's even that much risk because of the fact that most homeowners stay in their house and keep their mortgage somewhere between 5 and 7 years. So I think adjustable rate mortgages definitely have their place in the market. We might go back to seeing them a lot more frequently if we saw interest rates start to go up. And the short answer of why they're not really used is because in 2008-9, as the market was crashing, that was the product that the media latched onto to really vilify and tell the story of the mortgage market and therefore the collapse. So Scott Groves with another mortgage mystery. If you have any questions about getting any type of mortgage, a 30-year fixed, an adjustable rate mortgage, leave a comment, shoot us an email, get on our calendar. All the links are below. We would love to help you with a mortgage in the 10 or 12 states that we're licensed in. And if for some reason you're buying or refinancing a house in a state where we don't currently have a license, we can refer you to one of the other great loan officers we know who works in your local area. Don't forget to subscribe, hit the little likey button, leave a comment. We do these videos just as an informational tool, and we hope you're enjoying them.